Thank you for joining our webinar. We will start in just another moment or two to let a few more folks enter the webinar. Welcome to our presentation, Jumpstart, Buying Your First Home. My name is Emily New. I am the Community Relations Manager, and I will be your host today. We are delighted to have you join us, and with me is Larry Diller, an expert mortgage loan officer. Larry is a wealth of knowledge and has wonderful information to share with us. I'd like to cover some of the basics. All cameras are off and attendees are automatically muted. We want this to be an informative and engaging event, so we are eager to hear from you. There is an option to raise your hand and ask questions through the chat feature. We will do our best to answer the questions as they come in or when we are able. There will also be polls sprinkled throughout the presentation, so there are lots of ways to interact with us. A little information about our presenter. Larry is the father of two and the proud papa of two granddaughters. When he is not working, he enjoys hiking, singing in groups at church, and spending time with his family, especially his granddaughters. All right, let's get started.
Well, good morning. Thank you for joining us and allowing me to be here today. I'm excited to be here and talk about Kirtland's programs and first-time home buying. So on the agenda today, we're going to look at buying versus renting, what's involved there, and talk about our experienced team at Kirtland. We've got quite a wealth of years on our team here. And Mortgage Solutions, we're going to talk about our different mortgage products, what all Kirtland has to offer. And then one of the main things we want to discuss is our new Jumpstart program. It's a down payment assistance program that we think is pretty unique and is something that a lot of our members can really take advantage of. And then we're going to look at what's involved with numbers as far as budgets, and look a little bit at the credit score, talk about credit reports, look a little bit about how credit scores are calculated, just to kind of give you an idea of things to be watching for. And then what does the mortgage process look like? What all's involved with realtors, lenders, title companies. And then also to look at just real quick about pre-approval versus pre-qualification, what's all involved there, and you know, how much pre-approval is versus the pre-qualification. So in buying versus renting, there are a lot of amazing benefits for buying. Number one, appreciation, particularly in markets like this, where where in Albuquerque right now there's a limited supply of homes, so values have actually been going up quite a bit. So you definitely can look at appreciation. And then when you buy, it's an actual asset. So, you know, as that thing appreciates and you get that mortgage paid down, that becomes an asset that it can be very, very helpful to have. Collateral can be used as collateral for doing a cash out refinance at some point. As you get that balance paid down and the value increases, you can do a home equity loan to kind of access some of that collateral for consolidation, home improvements, that type of thing. Tax deductions, there are tax deductions. You can write off the interest and the real estate taxes, which can be very helpful. Now, right now, the standard exemption is pretty high. So, but there still are plenty of times where you can get those tax benefits. And then security, you can do with that home with whatever you want, make it secure as possible. And then you don't have to worry about, if you are renting, is that landlord going to sell at some point, or, you know, raise your rent more than you would like it to go up, those types of things. And then obviously end of payments. When you get that thing paid off, that becomes an asset at that point. And what are you paying? You're paying taxes and insurance, and you don't get that with renting. So there's some incredible benefits with buying. And then Kirtland has been around for a while, 60 plus years of service. We're the fourth largest credit union in Mexico and a full service financial institution. Checking, savings, all kind of loans. We have a wealth department too, where they can work with investments. So pretty good array of products that we have here at Kirtland's. And then the neat thing too, particularly that I like about Kirtland, is everything is local. Applications, decisions, everything are made locally, and the funding. And then one of the main things that I really, really like is the servicing is local on all loans. So you don't have to worry about paying us 1 month and then somebody out of state the next. You can actually come in and talk to somebody, or call, have somebody pick up the phone and answer your questions about your existing mortgage. So that is just huge in a market like this.
And that's a big deal. I know a lot of folks have experienced major amounts of frustration. I know that when I bought my house, I think in the first 3 months, it was probably sold 4 times. Yeah. And back then you wrote a check and I thought, who the heck do I make this check out to? So the fact that we're local, I mean, is just huge.
Yep. That really serves us well. And then these are the mortgage team. And we'll talk about a little bit about that more later, but we have a home loan center at northeast corner of Osuna and Jefferson is where we're located, but then some are working remotely as well too. So very experienced team. A lot of us have been, I'm not going to say we're old, but a lot of us have been around for a while. So.
And even with the restrictions now, you can still make an appointment to come in if you'd like to visit Absolutely. With someone in person.
You bet. Yep. And as far as our products go, we've got fixed rate mortgages, 10, 15, 20, and 30. With those rates being pretty competitive, and then a vast array of adjustable rate mortgages as well. 15, 15, 10, 7, 5, and 3, 1, and then 1, 1, and then a 5, 5 as well too. Probably the most popular is that 15, 15 ARM. And what that means is the payment is based on a 30-year amortization, but it does a one-time adjustment at the end of that 15 years. That's why it shows the 15, 15. And for example, that 10, 1 ARM means that rate would be fixed for 10 years and then would adjust annually after that 10 years. And then we do a lot of VA loans, obviously, with our niche. And the FHA is a great program too that can be utilized in cases where it is needed. If there's some credit issues or there's a little bit of flexibility in underwriting with that product, it's good that we have those products available to you. We do a lot of those. Jumbo mortgages, that right now is for anything above 510,400. And the neat thing with our jumbo mortgages is we keep them and we do all the underwriting locally. So it's not like some places do the underwriting locally and then it's being sold somewhere else and then there's additional overlays, other underwriting that comes into place. So ours are really, really good in that they're kept and we make all the decisions locally. Second home mortgages, if it's in a home that's in a different market from where your primary residence is, we do those as well too. Keep in mind though that we do only finance in the state of New Mexico. So we do have second mortgages as well too, and do a lot of refinancing. Obviously, with the way the rates have been this past year, we're extremely busy with refinancing. So that's a great way to save some money or to put some of that equity in the home to use by using some of that as well too. And then a lot of people don't do land loans and consumer construction loans. We do those locally here too, primarily in the Albuquerque metro area, although we will look at all parts of the state. And the land loans are done where it has to be a residential lot, and we will loan up to 75% of that sales price. And then we'll do that balance on a fixed 12-year amortization after that. And then the construction loans, that's typically where the member owns the lot, and then we can come in there and loan up to 80% of what that value would be by using the plans and specs and having those appraised. So there's still quite a few people that do the construction loans, but not as many as there used to be. So we're still proud that we can offer those products to our members when they need it. And then the Jumpstart, the down payment assistance program, will we talk about that more later?
Oh, let's see. Yeah. We will, but we're going to start with our first poll here. That should be coming up shortly. But let's go ahead and launch our first poll. And the question is, do I need to have 20% for my down payment? Would you say yes, no, or I'm not really sure? We'll give everyone a few moments there to chime in if they'd like to do so. All right, we'll go ahead and end the polling and we'll share the results. So Larry, it looks like people are kind of split, that they do think they need to have 20% down. So about half say yes and half say no, that you don't need 20% down. What are your thoughts on that?
Well, actually for mortgages now, it's helpful if you have the 15 to 20% down to avoid private mortgage insurance, but it is not required. Let's say on a conventional loan, you can actually get in with as little as 3% down, as long as you've got scores where you can qualify for the private mortgage insurance. And then on an FHA loan, you can get in with 3.5% down, and then plus your closing cost. So, and then on a VA loan, the neat thing there is if you have that VA eligibility, you can actually finance 100% of that sales price. And then you still need to come up with your closing costs and prepaids, but yeah, you do not have to have that 20% down. It's been quite a while before you've had to do that, but you do not have to have that. And we'll go over credit scores and some of those things later, but the credit scores do affect the rate that you're going to pay on that private mortgage insurance on a conventional loan, and the down payment that you put can help that monthly payment on the private mortgage insurance as well too. So the more you can save to have for that down payment, the better that's going to help your monthly payment in the long run. But no, you do not have to have that 20% down. So there are ways of getting you into a home for as little as 3% down.
All right, that's great information. Okay, we will just keep on going here.
Okay, so the Jumpstart program, that is an in-house program that we've had going for quite a while now. And what that requires a 3% down payment. So we will finance 97%, but the 3% of that comes as a grant from Kirtland. So it is a very unique and a very great program. Some of the things you do have to watch, though, is it does have a 4-year deed restriction. So that loan does need to be in place for 4 years. But then the neat thing about that, after that 4 years, that loan is, I mean, it's not a loan, that grant is gone. And so it's different than other first-time homebuyer programs where you're going to have your regular payment based on the 97% loan to value, and then plus another loan for your down payment assistance loan. But with Kirtland, you do not have that. It's very unique and it's a great program. Maximum loan amount's 206 because we will give 3% of that. So the maximum grant is 6,000 right now. And we say on here buyer contributes at least a minimum of 500, but you do need to have your closing costs and prepaids. And in a market like this, where I'm not going to say it's purely a seller's market, but you're not seeing the seller pick up as many of those closing costs as normal. So you still, in a lot of cases, have to come up with your closing costs and prepaids.
Now, when you say prepaids, Larry, what does that entail?
The prepaids are prepaid interest. So all mortgages are always due on the 1st. So depending upon when you close that date in that month, you prepay interest to the 1st of the next month, and then you wouldn't have a payment until 30 days out. So let's say you close in the middle of December, you would prepay to January 1 and then wouldn't have a payment till February 1.
Okay.
But then the other part of the prepaid, and probably one of the larger amount, is the homeowner's insurance. You have to pay that 1 year in advance at closing. And then when we start collecting 1/12 of it as part of your payment, we have enough in that escrow account to pay the insurance when it comes in a year. And then also taxes. You can't get away from that.
Yeah.
So you got to set up some money in an escrow account for taxes as well too. So those are some of the prepaid items.
Okay.
Unfortunately, you can't get away from those. And this is a 30-year fixed program. So you do not have to worry about that rate adjusting at any point. And then after that 4 years, that grant portion of the program is gone, and you've got that equity. And then in markets like this too, hopefully you have the appreciation equity as well as having paid the mortgage for 4 years and then having that grant go away. It's just a great product. Now keep in mind, private mortgage insurance is required. So this is where, when we talk later about credit scores, it's going to be very important that you work on that credit and have decent credit scores. Number one, you have to have a minimum score to qualify for PMI, but then the scores are based on your actual, the rates are based on your actual scores. So it's, and we'll talk about that later, but the credit scores come into play for this program as well. And then balance, this is something that Kirtland has been offering for years, and it's a great program. As a matter of fact, as part of that down payment assistance program, there is some buying your home education that is required, and it's really, really a good program. Once you complete that, you get a certificate. But then balance is great too. They have all kind of neat classes that you can take. They have money management counseling, debt repayment options. They can go over your credit report with you. So it's really, really a neat program, and I encourage all our members to take advantage of that program. Okay, so budgeting, so cash flow. What we're going to look at here is what a lot of lenders are looking at right now is your debt to income ratio. So in other words, they're going to look at your income, look at your monthly obligations, and look to see what kind of a rate you might qualify or what type of a program. And it's really important to try and keep those monthly obligations, whether they're vehicle loans, credit cards, student loans, to a minimum when you go to buy a house, because that can really affect how much house that you can qualify for. And then the down payment, obviously you need to save for at least that minimum 3% or the 3.5% down payment. But then the more you can save and come up with, that is going to affect the rate that you pay on your mortgage insurance. So the more you can save, the more options you have when it comes to getting into a place. And then the earnest money, you've got to think about not only having those prepaids and your closing costs saved up, but you also have to think about the earnest money. When you go to make an offer on a house, that seller wants to know that you're serious. So you're going to put anywhere from 500 to 1,000 to 2,000 down that the title company is going to hold in escrow because they're taking that home off of the market. So
makes sense.
yeah, so you got to think about that. So you not only you got to worry about the down payment and your closing costs, but you got to think about that that earnest money. And then the closing costs, yeah, we've discussed that a little bit, but that's you know, having those funds for the down payment and those prepaids, and then the extras. You always got to think about, you know, are you going to need to do any repairs? Are you going to need to have new furniture for this new place? A lot of things like that. Uh, and then the post-purchase reserve funds. All lenders really like to see that you've got some funds in there, in a lot of cases, a couple months, to make sure that you've got some of those reserve funds. Because when you're buying and it's your own place, something happens, there's nobody to call. There's no landlord to call. So you've got to make sure you've got some reserve funds set in place for those repairs, because inevitably there's going to be stuff happens, right? So you have to make sure that you've got some funds for those, and that for those extras, and then for maintenance when those things come up. Okay, what lenders want to see? Assets. So they obviously want to see funds in there for reserves. They want to see that you've got the down payment, and where is the down payment coming from? And all lenders are really looking at those down payment funds to make sure that they've, you know, been in that account for a while. And if there's a large deposit into your account, you have to kind of figure out where that come from. So sometimes it can be a gift. And all these loans, you can get a gift from family or other sources that can help you with that down payment amount. But then they also want to see assets to make sure that you've got some reserves, and if something were to happen later with maintenance, those types of things, that you've got some assets in there. So, and then steady employment history. In most cases, lenders like to see a 2-year history on your employment. But if you're changing fields, I mean, and that can be an issue. But if you're in the same field and you take a different job, you know, for better pay or better benefits, that is not a concern. Also, let's say you just recently got a degree or certification, and if you're using that degree or certification for the job that you're in and you haven't been there 2 years, we get transcripts and you can verify those certifications. So you don't necessarily have to have that 2-year history, but it's very, very helpful. Having that 2-year source is something that lenders look at. And then they also look at the credit scores. And what we're looking at there is, let's say it's just an individual applicant. We pull from all 3 credit reporting agencies, and then we use that middle score. But then if it's a joint application, we pull basically, you know, you have 6 scores, and then we're always going to use the low middle score. So that's why it's important on a joint application, for both applicants to have that credit be pretty decent, because that's what lenders are doing, is looking at that low middle score. And then tax returns can come into play if you are self-employed. If you're self-employed, then lenders are going to want to look at a 2-year history on your tax returns, and they'll average that income you're showing on your tax returns. And if it's depending upon what type of a business it is, there may be some, you know, corporate tax returns needed as well too, if it's a, you know, LLC or some type of a corporation. And then also on the tax returns, there's cases where we need to look at tax returns if a member has investment properties. So you have to look at a 2-year history on what they're reporting for income and expenses on that investment property. So there's certain cases when you have to have the full tax returns. But in most cases anymore, if it's W-2 income and there's a fairly good history on employment, a lot of times you can get away with pay stubs and W-2s. But anything unusual outside of that, then sometimes tax returns can come into play. And then the credit report, yeah, we're going to pull from all 3 credit reporting agencies for a mortgage. Different than the vehicle loan or a consumer loan, where you're just looking at a TransUnion report. On the credit report, we pull from all three. And the scores can be different. They all score just a little bit different. And there can be some things that come up on one credit reporting agency and not another. So that's why you got to look at all three when you're doing a mortgage.
All right, let's go to our second poll here. All right, and our second question is, does my credit score affect my interest rate? What everybody thinks. We'll wait just another moment here. All right. Well, it's pretty unanimous. Larry, it looks like everybody realizes that yes, indeed, the credit score will affect the interest rate of your mortgage.
Very good. And that is true. Not so much on a VA loan or necessarily FHA, although you still have to keep that credit pretty clean, make sure there's no credit issues. But particularly on a conventional loan, those credit scores do affect the rate that you're going to get, and that also affects the private mortgage insurance rate that you're going to pay too. So good answer. That it makes a huge difference.
Great job, guys. We'll go ahead and end the polling there and continue on.
So it's important before you get this process started to go and look at your credit. And really, on a mortgage, you want to look at all three reports because they can vary between Equifax, TransUnion, and Experian. So make sure you're looking at all of them. And if there's some things that can be corrected on there, if there's some inaccurate information, if you can work on some of those things before applying, that makes it so much easier, particularly when on a purchase where you get that purchase agreement and there's a time frame that everybody wants to close sooner than later, right? So it's important to have some of these things taken care of prior to, because there can be some inaccuracies in there that need to be corrected.
Yeah, I've heard about 70% of credit reports actually have inaccuracies. The information was entered incorrectly by the supplier, or maybe a name is really similar, it's off by 1 or 2 letters, things like that. But Larry, I just wanted to reiterate, you mentioned that say it's one individual applying for a mortgage, and we're pulling from Equifax, TransUnion, and Experian, and say Equifax is 800 and Experian for whatever reason is 650, and you've got TransUnion right there in the middle of say 750 or 725. You guys would go with that middle credit score.
Is that correct?
Okay.
Mm-hmm. Yep.
Okay,
so that's why it's really important to make sure if there's any inaccuracies to get that taken care of. Yeah. And where you can get the best rates, particularly on a conventional product, and where you can get better PMI rates too, is to get that middle score at 680 or above. That really makes a big difference. And then reduce or avoid debt. Obviously, that helps credit scores, and we'll kind of talk about those things a little bit later. But it can make a big difference on the amount of debt that you have, particularly on credit cards. It's interesting in that if you can keep your balance on that credit card at 50% or less of what the available limit is, that can really help your scores. So if you've got several credit cards and they're maxed or close to being maxed out, that can really affect that score. So you have to be thinking about all those types of things. And then that annualcreditreport.com is a place where you can go to look at that credit report just to see where you're at, see if there's any inaccuracies. And then how it's calculated, just to kind of give you an idea how they look at the scores. 10% of that, they look at, is there any new credit, the types of credit used. If they're all revolving accounts, it may be different than if there's some student loans or installment loans can be good. Mortgages obviously are good on there. So it's amazing. It looks at the types of credit that are used and the length of the credit history. So the longer you've had some of those things in place, and it shows an 18 to 24 to 36-month history, that's good, as opposed to something that's only been on the books for 6 months and there's not that much history. So that makes a difference on the credit score. And then the amounts that you owe, particularly on some of those revolving accounts, can make a big difference. And then obviously the biggest thing, the biggest category there is payment history. So keep those keep those accounts current, and that's really the main thing.
That's good. So we've got pretty good chunks there of payment history. So assuming you've been making your payments on time, and if you've been using credit for quite a while and keeping those balances low, you should be in a pretty good position.
In a pretty good spot. And even if you have some late payments, the further you get away from those late payment dates, it can really help. It really looks at the past 12 months and then to 24 months, particularly for the scoring. So the longer you get away from those late dates, the better that's really going to help the score.
Plus, it keeps a little more money in your pocket
Absolutely.
too when you don't have to pay late fees.
Okay, and this is just to kind of give you an idea. It's not necessarily how we do it, but it's just to give you an idea on that credit score, based on that question. Does that credit score affect the rates? And it can. So the higher the credit score, obviously, the better the rate that you're going to get, particularly on a conventional product. So keep that in mind. It does make a big difference. And then obviously, difference in the monthly payment. You want your payment to be as low as possible, right? So get that score up as high as you can to make sure that monthly payment is in line to where you want it to be. And then this is just to kind of give you an idea how some of these things could affect your credit score. And it depends upon what kind of score you currently have too. When you max out a card, you can see it makes a big difference, particularly when you've got really good scores. It can reduce those points. 30-day late payment can really affect the scores big time. And then you have to wait until you get 12 months to 24 months away from that late payment. Debt settlement companies, sometimes those can really affect those credit scores too. And then obviously the big ones, foreclosures and bankruptcies, that can have a huge impact on the credit score and can take you a little while to dig yourself out from that. And then the required documents, standard documents that you're going to need to be thinking about gathering and having in place when you go for that application. Most all lenders right now are looking for pay stubs covering the most recent 30-day period. So you got to keep that in mind too. So if let's say you've started a brand new job, and even if you've got an employment letter or something, any lender is still going to want to see those 30 days of the pay stubs. Okay. And then W-2s for the last 2 years. In some instances, depending upon how clean the file is, you can get away with just 1 year, but plan on having that 2-year history in there, particularly if there's any variances in pay. There's some cases where you want to do a 2-year average. So be prepared to have 2 years worth of your W-2s. And then bank statements. Lenders are going to want to see at least 2 months worth of bank statements. And they're looking for several things there, but mainly, if you've got those, we talked about assets before, if you've got money sitting in that account that you're going to use for the down payment or your closing costs and prepaids, they're going to want to see that it's been in there for a couple months, and they'll look at if there's any large deposits and you're going to be using that for the purchase. They're going to want to know where that came from. So is it a gift, and then do we need a gift letter, or just be prepared for large deposits to have to explain where that money's coming from?
Is there a limit on what the gift can be?
Not necessarily.
Okay.
No, there used to be some guidelines on a conventional loan, but not necessarily now, particularly with decent credit. So
you might need a letter stating that this father gave this daughter the money. Is that what you're saying? A gift letter?
Yep.
Okay.
And what that gift letter states is, and what a lender wants to look at is, I'm giving my son $15,000 for him to use for this purchase, but that gift letter states that no repayment is involved. So what the lender wants to make sure when we're looking at debt to income ratios, that there's no other payment that you got to be factoring in. Like if you, and you can sometimes do a secured loan for some of your down payment. Let's say you've got a clear title to a vehicle and you want to use that asset to come up with some cash to close. You can do that as long as it's secured, but you have to then include that monthly payment. So that's why sometimes a gift can be good, because there's no other additional monthly payment to go into your qualifying ratios. And then lenders are going to look at investment and retirement statements, because what's that's going to do. Sometimes there may not be a whole lot of liquid assets available in somebody's checking or savings account, but we've had a lot of members who have over the years borrowed from their retirement accounts or taken distributions from retirement accounts for down payment. And that's fine. And that can be a good thing, because let's say you're borrowing against your own 401k, if your plan allows it, uh, that payment, since you're borrowing your own funds, is not included in your debt to income ratio. So it can be really good to have those retirement accounts. And then in some cases too, the member may be pulling money out of an investment account. As long as you trace where it's coming from, then that can be. And then it shows. Remember, we talked before about having reserves. So if you've got investment or retirement statements, that can be huge. And then executed purchase agreement. We'll talk about that a little bit later too, but that comes into play actually after you have submitted your application. We've done the full pre-approval process. At that point, you would get an executed purchase agreement. And right now, in a market like this, where sellers can be pretty picky because sometimes they get multiple offers, and they're not really going to accept an offer without a legitimate pre-approval letter. And there's a lot of realtors out there too that will start working with you, but they may want to say, have you been in? And I want to see a letter that you're qualified. So it's yeah. And then there can be some miscellaneous things involved. You can use child support or alimony to help you with your debt to income ratios as qualifying income. You just have to be able to document it. And then we talked about that a little bit before, but you have to look at 2 years tax returns if you're self-employed. And the other thing I want to mention when we're talking about self-employed here, right now, you don't have your 2020 taxes done, right? So we're going to look at somebody's 2018 and 2019 tax returns. But then also due to COVID, there's some additional requirements right now on self-employed, where most lenders are going to want to see a profit and loss or your business account statements to make sure there's still deposits and the business is ongoing and it's active due to COVID. So it's a little bit different now on the self-employed. Still can be done, but it's just we're in unique times. So, and then depending upon the type of business it is, you may need the business tax returns too to support that income that's coming in for the self-employed. And the profit and loss statement and a balance sheet that can come into play. So it's you really have to make sure that it's an ongoing business right now. It hasn't been hurt too bad due to COVID. So. And then every time when we take an application, there is, when we pull that credit report, one document that comes out of that credit report is an explanation of derogatory credit. So you have to explain then, in a lot of cases, it's older and you just make that explanation. But if it's fairly recent, then you have to explain, was it just a one-time issue, or is it something that's ongoing and there's derogatories on a regular basis? So you have to explain those things. And those explanation letters look at prior residences too. And we want to look to see, was it a prior rental? Do you have an ownership in that property? Are there any other properties that you own that we've got to factor in expenses on that property? So there's a lot of things they look at on that credit report, but be prepared to do that explanation on the derogatory credit. And then if there was a bankruptcy involved, most lenders are going to want to see the bankruptcy papers. That's just pretty standard. And then divorce decrees too. You always have to go in and look at a divorce decree to make sure that there's no child support or alimony payments, any of those things that are involved, because if there was, then those have to be included in the debt to income ratio. So just be prepared for all those things.
All right, and let's go to our third and final poll here. All right, the question is, the entire mortgage process usually takes how many days? Would you say it probably takes 30 days or 60 days or even 90 days? Go ahead and make your selections. We'll give you all just another moment if you'd like to chime in. All right, we'll go ahead and end here. Well, Larry, it looks like we're split between folks thinking that it takes either 60 days or 90 days for the entire mortgage process. Would you like to speak to that?
Sure. So as far as the pre-approval process, like if you're coming in and you want to get a letter to go out and make an offer, since everything is done locally with us, that doesn't take all that long. Normally, just a few days. But as far as actually then having that pre-approval letter, getting a purchase agreement, and getting the appraisal and all the title work and all that on a purchase, those are taken 30 to 45 days, and we like to see 45 days given for in between the date that you've got that purchase agreement and closing, just because appraisers are getting a little bit backed up. Title companies are not as quick as they used to be. So that process is a 30 to 45 day. Now on the refinances, that can be a little longer depending upon the number of files that are sitting in somebody's pipeline. So those can take a little while, anywhere from 45 to 60 to sometimes 90 days, depending upon.
Okay, so we're seeing the refinances take a little bit longer than a purchase. Okay, that's good to know. But we are shooting for that 30 to 45 days on a purchase. Correct. But based on our market, there's a lot of things that are out of our control that might take a little longer.
Yeah, some of the things that come into play there is you get that purchase agreement, and then one of the biggest things you see right now is inspections, right? So sometimes you have to wait, depending upon how busy inspectors are, a week to week and a half out before they get those inspections done. And some cases they want to wait and order the appraisal after they know everything's good there, before they spend the money on the appraisal. So that can delay things a little bit. But in some cases where they've done that homework beforehand, or you're not waiting too long to get those inspections done, it can speed up the process as far as when you can close on a purchase.
All right, that's great information. Thank you so much. We'll go ahead and end here and then continue on.
So the mortgage loan process, everybody has their own responsibilities. Obviously, the borrower has a lot of work to get that credit in place and get their assets in place and monies to close and getting their debt to income in line. And then lender has responsibilities as far as getting it all underwritten and getting a pre-approval letter out there, and then getting the appraisals ordered, title work cleaned up. The seller obviously has responsibilities. And then the escrow company, the title company, they all have specific responsibilities as well too. One of the things you're always going to have the title company look at is a binder or a preliminary commitment. They look at that property to see if are there any mechanics liens, or are there any judgments against the seller. They also look at the borrowers too, look to see if there's any judgments or tax liens or anything out there. So there's a lot involved with everybody's responsibilities there. So, but your realtor and lender will guide you through the process. That's why it's very, very important on a purchase to make sure you have your realtor that's representing you to help you through this whole process. And then the lender, that's one of the things I like about Kirtland, is that we're not on pure commission. And so it's all about establishing relationships, right? And so we love to spend our time, particularly with first-time home buyers, to help you through that process, to make sure you and kind of hold your hand as you go through it. So
I wish you were my lender for the first time I went through the home buying process.
But yeah, no, it's really, really great. We've got some very, very good people that love working with first-time home buyers. So, and then we've talked about that, but be sure to have all the necessary documentation together to speed that pre-approval process up when you get that started. So one of the final things now is pre-approval versus pre-qualification. So that pre-approval, that is something that you would need if you are to the point where you're working with a realtor and you're thinking seriously about making an offer. So what that is, it's firm numbers. We do a complete full underwriting on those, where we're going to gather up your income information. We're going to pull that credit report. We're going to get the explanation on any derogatories, those types of things. And then our underwriter will then issue us a pre-approval letter. And that's good for 90 days. Because when you pull that credit report, that's good for 120 days, but we typically do our pre-approval letter good for 90 days. So when you start that process, you still got plenty of time to be out there looking. And then there's a small fee that is mainly for the credit report, because you have to have that tri-merge credit report where we're pulling from all three agencies to make sure we know exactly what's going on. So that's what's involved with the pre-approval. Now the pre-qualification, you may just want to come in and say, hey, I want to get an idea what I qualify for, or can you look at my income in relation to my monthly obligations as to, you know, where I might be. And if you're just trying to get an idea, that's it doesn't have a fee because we're not actually pulling a credit report. It's neat with Kirtland. You might have a relationship with us and we can go in at a prior vehicle loan and see a score and get an idea. So that really helps as a credit union. But that's not, you're not going to get a letter in that case. It's not a full pre-approval, but you may just want an idea. Hey, I really want to start looking in the next 3 to 6 months. Can you give me an idea what I qualify for? We can do that for you as well too. Our mortgage system has a real neat qualification formula that we can go through. So
now here we say small fee. Can you give us an idea of what that fee is?
on the credit reports, for an individual report, it's $35, and for a joint report, it's $50.
Okay, so not bad at all.
Mhm.
Excellent. And in this type of market, you guys would generally strongly recommend which of the two?
Pre-approval. I mean, if they're working with a realtor and they want to go out and make an offer,
Mm-hmm.
they really need to get that full process done to get that pre-approval letter. And then real estate agents, it's you really want to do your homework there. We can always give you some referrals, but then, you know, talk to family and friends. Make sure you're dealing with a realtor that's familiar with the area that you're looking to buy in. They're going to know, you know, schools, crime rates, you know, the market in that particular area, all those types of things. And then if you're a first-time home buyer, you want to find somebody that is willing to work with you as a first-time home buyer and really be good at the education process and to help you out there too. And then I know I touched on that earlier, but you really want to find your agent that's representing just you instead of you and the seller, because otherwise that, you know, that agent may have a fiduciary relationship to the seller, but you want to have your agent be looking out for you, right? So you really, it's best to get your agent that's working with you to then do the negotiations with the listing agent. So, and then yeah, don't be afraid to interview several and see which ones you might have a good fit with. So, you know, their history, or, you know, their interest, or what's their strength in the particular market that they're dealing with. So don't be afraid to to interview several. And then read before you sign. Yeah, with both your realtor and your lender. One of the things that lenders will do now is there's all kind of disclosures that are involved initially. There's a pre-disclosure packet before we even, you know, pull the credit report. It gives you an idea on certain things. And then when you get a purchase agreement, there's a whole application packet that's involved with all kind of wonderful disclosures. And then there's a loan estimate too. That'll give you an idea of what's needed at closing, what's my payment going to be. And then with your realtor too, the same thing. Most everything is done electronically now, right? Electronic signatures, but still make sure they're taking the time to explain what you're signing. And so you're not, you don't have any surprises down the road. So.
Well, thank you so much, Larry. This has been wonderful, so informative. We do appreciate your time. I'm going to wait just a moment here to see if we get any last minute questions that pop through. And while we're finishing up, you can still enter in those questions. But we do want to let you know we have some great new webinars and events constantly coming up. So once the slides have concluded here, a screen will pop up as soon as we close, and we would appreciate you taking a few moments to share your feedback with us. And as a token of our appreciation, an attendee who completes our feedback survey will randomly be selected to receive a gift card for $15 to Target. And in the event you're not able to complete it now, keep an eye on your email box where there will be a link from Zoom to complete that survey. If we were unable to address your question right now, or a question pops up after we've closed this webinar, feel free to contact us at 505-254-4369 or come into a branch or set up an appointment with our folks over at the Home Loan Center. So thank you again. We look forward to you joining us in our next webinar, and enjoy the rest of the day.